Kitco News, special coverage of the Decentral Miami Conference, is brought to you by Cook Finance, a revolution in DeFi asset management.
We're back with Michael So of Cook Finance. Welcome back to the show, Kitco.
Great to be back.
Good to see you here in Miami. We're here to talk about a trending topic, DeFi 2.0. It's not often discussed in media, but it's important, so let's talk about it. But before we talk about 2.0, let's talk about DeFi 1.0. Conceptually, what is that?
Absolutely. DeFi 1.0 can be defined by three distinguished features. One being the organization, DAO, which stands for Decentralized Autonomous Organization, meaning everything decisions-wise driven by the organization, by the community, rather than by a top-down structure. Second being the pillar of how the value are being transferred, not in a centralized way, but rather on a network, such as Ethereum, the network, Avalanche, the network, And third being, the DeFi actually means non-custodial ownerships, meaning it doesn't, stands with a centralized custody, but everyone with a MetaMask wallet, for example, can own the assets on their own, basically.
Okay. Can you give me some examples of DeFi 4.0?
Absolutely. Like, for example, Uniswap, the network, with the Uni token, Aave, the network, also with the Aave token, governance token, a lot of folks, can own the governance token in their own wallet. At the same time, they can use it in the network. Those are the two primary examples.
And just following up briefly on our last conversation in Dubai about DeFi versus CeFi, what you described here, the major differences between this structure and, let's say, traditional financial structure.
That's correct. Yeah, I mean, traditional finance, as we know, they're extremely centralized, and a lot of the times, what it means is that, we are subjected to the rules, basically decided by a organization that is from a top-down structure, and DeFi, completely basically changed the game, in a way such that, anyone who has a stake are able to have a say in how everything can be decided.
Okay, DeFi 2.0 then? How is that different from DeFi 1.0?
Right, it's a deep topic, I guess, one way to put it is that, in DeFi 1.0, a lot of the tokens, a lot of the protocols, look for ways, to attract community users, to find use cases on the network, One of the things that they do is by doing staking, And if I were to water it down a little bit, you can think of it as in the existing financial systems, how in the monetary systems, a lot of currencies, would print money similar to US dollars, similar to, let's say, Bank of Japan, Bank of China, Bank of England, they will continue to print money to increase the circulating supply. And at the same time, think of it at another angle, it actually creates inflation. At the same time, if you were to think of it another perspective, it also means that the money in your account remains the same while the circulating supply keeps on increasing, meaning the share that you own from a supply perspective, reducing. And if you were to think of it that way, a lot of the protocols are trying to mimic the exact same dynamics, at the same time trying to give people an idea that you're not losing your share, you're basically being rewarded by staking the tokens onto the network. At the same time, this is how we define yield. This is how we define, the fact that you're rewarded, for using the network itself, And that's how I think of it as, the DeFi 1.0.
Okay. You mentioned to me offline that the core concepts of DeFi 2.0 are similar to our current monetary system. Can you explain that?
Yeah, so I came from Hong Kong myself. Hong Kong dollar is actually one of the stable coin, if you will, which is a one
pegged to the USD. Yeah.
Exactly. However, at the same time, the treasury backing the Hong Kong dollar, it's not just one-to-one. As a matter of fact, it's every single Hong Kong dollar is backed by one single US dollars with a current exchange rate of 1 to about 7.78. That means that it is over collateralized. However, in the open market, in the FX market, they're being traded at a price of actually only one Hong Kong dollar, meaning the value, even though it is being realized at one Hong Kong dollar, it is over collateralized 7 times. Now, DeFi 2.0 actually is using that concept as well. So one of the most famous network on DeFi 2.0 is Olympus DAO with a token called OHM. They borrow the same concept. They have a floor price of 1 DAI. However, because they are over-collateralized in such a way that is basically allowing people to value it differently than the intrinsic value, now they're able to basically allow the secondary market to trade the OHM token many times more than the original intrinsic value. And that's exactly what the DeFi 2.0 is about. They're looking for ways to make people attract to the protocol such that it can convert into what we call the total value locked. At the same time, once people realize the fact that this is something that everybody is using, they will start using the network.
Okay, but what's the comparison to a stable coin then?
Yeah, stable coin, for example, the likes of USDC, backed every single dollar by another dollar. The Tether, backed by cash equivalent commercial papers, they have a one-to-one backing, not over-collateralized. Every single dollar will be backed by a issuance of one Tether, one USDC, and that's the difference between a protocol such as OHM and the token versus that of a stable coin. It is namely, there's a floor price to OHM. At the same time, there's also over-collateralized value that can be realized by the secondary market.
So what are the projects of DeFi 2.0 that maybe you're following right now?
Yeah, OHM is one of them. There's another one that's called Token Mag. Actually, it's very new. It's only been 4 months, but the market has already been receiving it very positively. But at the same time, it is new to the point where everyone is testing the use case, trying to see, if projects, can continue to grow and survive, this kind of up and downs, that we typically see in the crypto market.
What is this DeFi 2.0? What does this development mean for investors or traders?
Yeah, so one thing that in the crypto side, a lot of folks look for is the yield. So what's happening is that DeFi 2.0, not only do they basically print extra tokens to reward the original staker such that they don't get diluted from a market share perspective on the circulating supply, but at the same time, they also have something called a bonding. Bonding, what it means is that they will actually lend some of the liquidity pool tokens back to the protocol itself, and they will actually earn extra yield in the form of a token again. I know it's a lot of concept to unpack. And third but not least, they can actually use some of the treasury locked up by the bond to buy back the tokens on the open market, such that the floor price can be supported. So interestingly, they kind of tie back to how the existing economy works. FX markets, monetary systems, things like that.
So it's mostly for yield generation, I guess.
Absolutely, and that's one thing that's driving the market. Because as we know,
Let me ask you if this is a good idea. Okay, I've heard, and I asked this to somebody else. I've heard that some engineers in the States, or Canada as well, they're actually asking for their salaries to be paid in USDC or USDT because they can stake it and earn a higher yield than their fiat currency. I don't know if you think that's a good idea.
Well, it's all about the risk, at the end of the day, risk and reward. If they're looking for the yield, which is very attractive, they probably have to gauge, whether or not the risk is justified, such as the smart contract risk, or any other counterparty risk, if you will, from a protocol perspective, meaning if this project is going to survive,
Why would there be counterparty risk?
Oh, because the project in itself, sometimes may not be able to survive, from a funding perspective, which is very real, in the crypto world, So what happens to a protocol after, let's say, for example, the team is gone, can be very interesting as well,
In a DAO structure, let's say I stake a project, and then the project issues more tokens. What happens to my share?
Actually, your share will remain, right? If you continue to get rewarded, but at the same time, like I said before, DAO in itself will continue to run. But whether or not it is being maintained is another question altogether.
Okay, so my share wouldn't get diluted by more issuance?
No, as long as you get rewarded for the staking part. But however, if you decide to not participate in the staking side, then it will be very similar to our current economy.
But if I stake it, I can't withdraw my cash in a certain time period?
That's right. So that's another concept here, right? Once you stake it, you don't lose control of it. You just simply cannot use it anymore. But whereas if you think of it as a bond, you actually lose title. They will be able to rehypothecate, the assets, and earn extra yield.
How do I know I'm not going to get rug pulled?
That's a tough question, as always, but oftentimes, it is actually shown in the market price, of token, where you rely on basically the community knowledge, if you will, the crowd knowledge, if you will, such that, a lot of times you have to receive information that way. But however, smart contract is extremely transparent. I think there's also another way, for people to, a little bit more technical, to find out whether or not, something is legit or not.
Did you buy Squid Game coin?
I did not. That's the key part.
You did not buy or sell at the right time. You just didn't touch it at all.
I did not touch it at all. But on my team, we got guys, analyzing the contract. We understand it's a buy only, no selling token, which is not the easiest thing to solve.
That's important because you look at some of these things. How do you evaluate if something is only buy only?
Yeah, as a protocol, as a DeFi DAO structure, based, project ourselves, we go through very rigid, a protocol and procedures, right? One of the things that people look for is the fact that it has to be audited. The smart contract has to be audited. The team has to be vetted. I think that's very important.
All right. Okay. Finally, objectives of DeFi 2.0. What is it trying to accomplish besides providing better yield?
Yeah, from a crypto's perspective, a lot of times they're trying to prove the fact that they have a lot of token value locked value. So TVL, as we call it, and at the end of the day, we are all trying to find use cases for all the DeFi projects, protocols, things like that. And one day, I'm sure, a lot of the traditional economy will convert over in a DAO structure in a way such that everyone can participate.
Perfect. Thank you so much for your educational insights. I appreciate you coming on the show.
Wonderful. Thank you. Have a good one.
And thank you for watching Kitco News. I'm David Lin.
Kitco News, special coverage of the Decentral Miami Conference, is brought to you by Cook Finance, a revolution in DeFi asset management.